Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock, with news emerging economies are struggling to handle the fallout of a new chaotic trade environment. Firstly, it looks like China has had a small blink in its trade tussle with the US. Omitted from its tariff retaliation was American crude oil, although sourcing that still will help keep prices down from other places like Iran, where volumes are rising. In the first world, Canadian housing starts fell sharply in June, consistent with yesterday's weak building permit data. Japanese machine tool orders rose more than expected in July, up 13% and far better than the 11.4% rise in June. In China, consumer prices rose at a faster pace in July, up 2.1% due to large increases in food and fuel prices, while factory inflation slipped, even though it's still at a high level of 4.6%. Beijing is using the Shanghai markets to drive down interest rates. Overnight SHIBOR, a measure of the shortest-term bank lending rates, fell to 1.42% yesterday, its lowest since 2015. At the end of the day, a little higher, however. This is a mechanism their government is using to try and stimulate their economy by ensuring lenders have plenty of cheap funding to support businesses and consumers during the uncertainty of the trade war. Yesterday we reported a slowdown in the growth of air cargo traffic. Today we can report that international passenger traffic growth seems to be rising and faster. Worldwide passenger traffic was up 7.7% in the June year-on-year. In the Asia-Pacific region, it was up 9.5%. Both of these rates are faster than were reported previously in 2018. Meanwhile, in some key emerging markets, new sanctions drove down Russia's ruble, while worries that Turkey was sliding to a full-blown economic crisis battered their currency. The Argentine and South African currencies were also hit hard. US Treasury 10-year yield was down sharply at 2.93%, a 4 basis point fall in a day. Their 2-10 curve has slipped to 28 basis points. This is despite the US Treasury saying it will sell an eye-popping $122 billion in new debt next week, taking the total US federal debt held by the public to $15.6 trillion, or 78% of US GDP. The Chinese 10-year is at 3.56%, that's up 3 basis points, while the New Zealand equivalent is now just on 2.71%, and that's down a very substantial 7 basis points. And as we reported last night, New Zealand swap rates took a heavy dive yesterday, down about 10 basis points across the curve. Gold is little changed today, down $1 to $1,212 an ounce, and oil prices have stopped falling and are now just under $67 a barrel in the US. The Brent benchmark is just over $72 a barrel. The Kiwi dollar is starting today very much weaker, having been dumped on after yesterday's RBNZ MPS and foreign terrors trading halt. It is now at just 66.3 US cents, more than 1 cent lower. On the cross rates, we're very much lower as well, at 89.7 Aussie cents and 57.3 euro cents. That puts the TWI at 69.9 and under 70 for the first time in nearly 3 years. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.